Bharat Forge has delivered its Q2 report card, an important and a leading auto ancillary player. And the numbers that they've reported for the quarter gone by have been a tad bit dismal, I would say, or they're below expectations on all counts, whether it's top line, bottom line, or the operational performance. Let me take you through the numbers first. Revenue came in at 881.5 crores. Profits have come in at 70.2 crores. EBITDA at 166 crores, implying that the margins came in at 18.8%. And our expectations of the margins was more than 20%. So definitely a bit of a disappointment on that front as well. They have given a clear-cut update on India as well as international business, domestic as well as auto as well as non-auto business. So let me take you through that step by step. As far as India auto business is concerned, the domestic auto industry has started showing some signs of recovery from July, August onwards as economy started reopening. Fleet utilization improved sequentially, resulting in the firming up of freight rates. Every segment of the CV industry has witnessed a rise in demand. M&HCV production, of course, or rather M&HCV demand and recovery has been relatively lower than that of LCVs and ICVs. They are the ones which are seeing a sharper rebound. With gradual reopening of the economy, there's festive season as well, which continues to go on and spur the demand in a big way. Revival of CV financing, improvement in supply chain. Industry is expected to show good improvement in second half. That's what the company is projecting at this point in time. Sustained recovery, however, over the medium term hinges on macroeconomic revival and pickup in infra projects, construction as well as mining activities. So a full-fledged recovery in the M&HCV space will not happen over the near term is what the management is essentially saying, and any meaningful recovery is expected only by FY22. All sectors in the industrial business, domestic one, have shown good sequential growth in line with the uptick in industrial and agri activities as the economy started reopening. As far as global operations and businesses are concerned, North America and Europe heavy truck production has recovered faster than expected from the lows of April and May. Freight activity has increased. Fleet operators are returning to previously planned replacement cycles. Demand in both markets, which is North America as well as Europe, has increased on the back of freight volumes, higher freight rates, some pent-up demand in the replacement cycles as well. Demand is expected to be stable at present range in the near term, with buyer confidence increasing as the economy recovers and generates ample freight. As far as the non-auto business is concerned, within the international business segment, there is definitely some pain points there. Business activity across most sectors barring oil and gas within the industrial space have improved sequentially, resulting in increased customer demand. However, the biggest driver of their industrial business over the past many years has been the oil and gas sector, and that has been severely crippled by the pandemic without any semblance of a recovery in the near term. So lots of cautiousness being sensed there as far as this particular sub-segment is concerned. Aerospace is another element within the industrial basket which is facing severe headwinds. They're already working to fill up revenue pipeline from other sectors, but they expect the result of these efforts to only kick in over the course of the next 12 months. Essentially, what the management is saying that Q2 numbers were largely on expected lines. There's definitely visible traction from the domestic front. Export revenues, however, are continuing to witness a decline. On the export front, they are seeing some signs of improvement, especially in CV segment, but given the second wave of COVID, especially in Europe and North America, they will be keeping track of it very closely. They're looking at restructuring of India and international operations to enhance sustainability. They're focusing on incorporating more digital solutions to manufacturing. They're making steady progress on further optimization of fixed costs as well. So largely they're working to sort of aid recovery and aid the financial performance as well for the company, but definitely there are a few pain points that they have flagged off, and it will take about 12 to 18 odd months for things to stabilize meaningfully.